Discussion on financing growth and aspirations of the states, opportunities for issuers and investors. We have Mr. Dhawal Dalal, Ms. Subalakshmi K, and Mr. Sriram Mahadevan, a session to be moderated by Ms. Aarti Krishnan, Consulting Editor, Business Line, Head of Investments and Insurance at Prime Investor. Ms. Aarti Krishnan is a cost accountant and an MBA and has been closely tracking the Indian financial markets for over 25 years now. She started her career with Hindu Business Line as a research analyst in 1995 and went on to head its research bureau and was editor of its portfolio section for about 7 years. She moved to a consulting editor role in 2014 while continued to write on economy, regulations, and market for both Business Line and its parent publication, The Hindu. She currently writes on bonds, insurance, and stock markets for a Prime Investor. For her pioneering work on financial journalism, she was awarded the Sriram Sanlam Award for Excellence in Financial Journalism multiple times. She is presently a member of SEBI's Mutual Fund Advisory Committee. I invite Ms. Aarti Krishnan to lead the session.
Good morning, everybody. I thank the CFA Society for inviting me to moderate this session on state finances. Also because it afforded me a lot of learning opportunity. I mean, typically central government bonds are more closely tracked than SDLs, but this gave me an opportunity to read up on it. And we also have a section on muni bonds, which is a completely unfamiliar territory to me, and I hope to learn a lot from our session here. So, the title of this entire event is Regime Shift, and typically when yields in the market move up, there's a sort of sense of gloom among fixed income investors. People who are already holding a bond portfolio, it is a tough time indeed, because you do suffer some depreciation and you have to manage risk. But for new investors, these are exciting times because they're the kind of yields that we never thought to see in the market. Today we are getting them even from sovereign securities. So, state government finances are of particular interest today because first there's this debate about whether state governments are overstretching themselves on freebies, etc., finances sound, etc. But from an investment point of view, actually, state governments are becoming very large issuers of securities. So for FY23, if you see, state governments are set to borrow 12 lakh crore as gross borrowings. Almost, while the central government is at 15 lakh crores. So there's a large supply of state government securities. And the yields too have turned quite attractive. So earlier there used to be not much distinction between state and central or between different states, but we are seeing the spread slightly opening up between different states. And lately we've seen periods where SDLs have offered 70 to 80 basis points over the central government security, offering attractive opportunities. In fact, I'm an investor via the RBI Retail Direct platform, and say 6 months ago, I was able to buy a Tamil Nadu government bond 2062 for 8.3%, and I thought it was a great deal because the annuity schemes that you have for retirement will give you 5 to 6% IRR. So those are the kind of opportunities there. So let me introduce the panelists and invite them to the dais, and I hope that they can shed more light on the opportunities as well as the risks in this new asset class. Not new, but newly discovered. So first, may I invite Mr. Sriram Mahadevan to the dais. Mr. Mahadevan is a CFA charter holder, and he's been an active investor in the bond market since 1997. He is currently associated with the investment function at the Azim Premji Trust, and the endowment manages over $34 billion in economic interest. Prior to this, he was at Wealth Advisors, and he was part of the formative founding team at Wealth Advisors. Please, Sriram. May I invite Ms. Subalakshmi to the dais. Ms. Subalakshmi, who is the founder director of Munify Datatech, it has 20 years of experience in credit ratings and bond markets. She heads the first national database which has created a database of financials of municipal corporations, which I'm sure all of us will find quite eye-opening if we explore. She spent the bulk of her career with CRISIL, where she used to look at the ratings for public finance and infrastructure. Subalakshmi, please. Next, I have the pleasure to invite Mr. Dhawal Dalal to the dais, an MBA from the University of Dallas. He is the CIO of fixed income at Edelweiss. Prior to this, he was with DSP Merrill Lynch, and he's been actively tracking the bond markets and has been looking at global trends, geopolitical trends, etc. in this market for the last 20 odd years. Dhawal, please. Right. Now let's kick off our discussions. May I request each of the panelists to make some opening remarks, please, say 5 minutes each. Could we start with Mr. Mahadevan?
Sure. Hi. Very into as fixed income market, but there is a growing presence of states, right? Multitude of states which have kind of dominated the landscape the recent past. They do offer relatively better yields than government securities, and acceptability of state development loans among investors is slowly growing. So, what kind of differentiates strength of any asset class or probably any borrower is the level of acceptability that it has. You know, it's not sometimes net worth or refinancing capability that supports the ability to repay. It is the access to capital market and faith from investors. So, as more and more investors believe in a particular organization and are willing to lend money to that organization, right, you see that those organizations kind of gain strength in their ability to refinance. I mean, contrast an individual borrowing versus a government borrowing or a corporation borrowing. And individuals borrow basis their salary and income, whereas corporations and governments borrow basis their ability to refinance. So, hence, you know, refinancing ability, as more and more people accept state development and these credits as reasonably good credits, you see that they start to dominate the landscape slowly, right. The spectrum of investors who used to invest in these bonds have been growing. I remember about a couple of decades back, I don't think mutual funds did invest in this asset class in a major way, primarily because they were categorized as less liquid. Even today, the difference between the on the run security and off the run security is very high. So, it is not so easy for you to liquidate a state development loan so easily as it was as it is today. So, hence such frictions do exist, but these frictions also kind of give you an opportunity. So, it's not risk in absolute or returns in absolute. It is risk adjusted return. You are able to time certain cycles, structural issues in the market, they become huge opportunities for you. So I think it's coming of age. Acceptability is getting wider. Investors have started reposing faith. It's very nice to see individuals kind of take that exposure to invest in a government security or state development loan for such long. Thank you.
The municipal bonds market is pretty tiny. We've had about 5,500 crores of issuances since 1998, so that's not much, right? Especially when you see that corporate bonds issuance is about 6 lakh crores a year. And if I tell you in the US, the municipal bond market outstanding as of Q2 2022 was $4 trillion. You can see it's a small market, but it's a growing market, and the government of India is quite very keen on having this market grow, which is why it is even announced a 13% incentive. So, for every 100 crores of bonds you raise, you get back 13 crores. So that, you know, munis look at the bond markets and not just as bank loans. So, what is stopping this market from growing? The answer is the credit quality of the municipal corporations. The ability to borrow on the size of their balance sheet is limited because many of them are financially weak. Just to give you one data, about 450 municipal corporations were rated under the Amrit scheme, and only 1/3 of them had ratings of BBB and above, which means only 1/3 of them were investment worthy, right? And there have been other issues also with also a lack of transparency among the munis. This is one of the hardest sectors for you if you are a data researcher or a student, which is why we built the database in the first place. The revenues that are available to municipalities is limited. Property tax is the primary source. And the property tax to GDP in India is about say about 0.15% of GDP, whereas for developing countries it would be 0.6% of GDP. You can see that we really trail over there. But own revenues are improving, and they have now a greater basket of revenues to strengthen them. One thing that is really growing is the betterment charges, the building permit fees. With all the construction that is happening, city corporations are benefiting from it. Going forward, city governments will be much bigger than even the national governments. Today, more people know about a Sydney, a Melbourne, a Delhi and Mumbai than really know what a government of Australia or a Victorian government is doing. Because cities are in the forefront of all aspects relating to climate change, net carbon emissions, and these are the entities that are going to fight these challenges in future. Even during COVID, we found that the last mile giving the service to the citizen was the municipal corporation. So that is why you have very large mission programs happening in the country. You've had Smart Cities mission, and then you had this Amrit mission. Put together, there were 1 lakh crores in their first phase, and say 50% was coming from the center. We expected the project size to about 2 lakh crores at least. And that is the level of infrastructure requirements in the country that is expected at the city level. The urban infrastructure requirements is at least 2 lakh crores a year. And where is all this funding going to come from is something that we will see in these sessions. Thank you.
Yeah, thank you. So taking forward this theme of regime shift and what Sriram has said and earlier what Prasanna had said, there has been a significant improvement in the acceptability of the state development loans across the segment of the markets. Earlier, as was widely expected, that the banks would probably be one of the largest buyers of state development loans. Now we are seeing that out of the 42 trillion rupees worth of outstanding state development loans, the share of banks is declining. Earlier, they were almost about 60% holder of the outstanding SDL. Now that amount has now dropped to about 40%. And surprisingly, now more and more players are coming to take their shift away. Number one is insurance and pension funds. Second thing is corporates. You will be surprised to know that corporates have now become one of the, very, very significantly growing category for state development loans. Mutual funds are also now almost owning 80,000 crore of state development loans, and I think with the introduction of target maturity bond ETFs and index funds, which are now have a slice of their portfolio invested in high quality papers like SDLs and government securities. With that invention, we are going to be able to see a very steady demand for SDLs going forward. With some power of hindsight, the recent changes in the regulation by SEBI pushing mutual funds to high quality assets has also been a blessing in disguise for an incremental demand for SDL from mutual funds. And I believe that as the time will go, you are going to see more and more market participants becoming very, very powerful investors in SDLs. The volume, secondary market volumes are also now improving. Last time when I checked, I think average daily volume has now increased to 3,000 crore, give or take few, as against 30,000 crore for government securities. So the volume is increasing, and I'm pretty sure that I think out of the 20 states who are frequent issuers, we have also seen a diversification of issuances. The minimum tenure was 3 years, maximum tenure is 30 years. So that is also now moving along the kind of development that we have seen in government bonds market. Right. We have also seen reissuances of state development loans. This is also has been a long-standing demand for the market, that rather than coming out with new SDLs every week, there has to be some amount of consolidation. So we are seeing the market moving in the right direction. And I'm pretty sure that once the states that is issuer and the investor, currently there is no direct linkage in terms of issuers knowing what investors want and investors don't know how to communicate to the issuer what they want. Well, I think the next stage of evolution will be that a summit like this, where all the states will send their representatives to understand what market wants, and how should they capitalize on what the demand from the market. That in turn will probably result in more harmonious supply of SDLs and tighter spreads. Last year we saw the spreads widening, as you must benefited about 80 basis point over 10 year. This year the spreads are about 30 to 35 basis point. I believe that assuming the risk perception is identical, that is a sovereign risk, this 30 basis point or 35 basis point incremental return is a free money. And that in my view is only represents illiquidity, that your ability to sell this bond in the second market. I believe over a period of time, with the mutual fund, insurance, pension funds, corporates getting more mainstream, we should see liquidity improving as well, and the consolidation in supply in turn will result in tighter spreads. So this is an asset class in my view looking for exponential growth, and I think mutual funds are also trying their bits, and summit like this will increase more awareness about the investors and give more comfort, and that in turn will bring more money.
Right. So Dhawal, that actually brings me to the first question. You're saying that actually there's not much distinction between state governments and central governments, and both are sovereign. But actually when you mention SDLs, I was speaking to some people just before this webinar, seminar also, and say, given the state of state finances, can we really take this exposure? So there's this narrative that has been built that state government finances are precarious and therefore there is risk, credit risk in SDLs. Now when I looked at the actual numbers, I didn't get that impression, because if you look at the fiscal deficit to GSDP, they've all been consolidating well, and actually it's much below the center's fiscal deficit, nor is the debt to GDP alarming in most cases. So, Dhawal, I mean, what is this perception of credit risk, and isn't there an escrow mechanism to manage payments?
See, Arti, that's a very valid point that people are raising, that. And that's also one of the reasons why FPI's holding in SDL is virtually zero, whereas they keep on holding large sum of money in government securities as well as corporate bond. Surprisingly, they've stayed away from the SDL holding. Whereas from the local investors' perspective, there is an enormous sense of comfort, primarily because the SDL supply and servicing is being done by RBI. There is no clarity in terms of information about the backup mechanism, about how RBI is servicing SDLs in terms of coupon payment as well as maturity. But we are given to understand that everything is done through the Consolidated Fund of India's state share of central tax revenue. So long as the RBI is servicing this kind of bonds, so long as the risk weight in the banking system is zero, we believe that local investors will probably have more level of comfort. The other point is that the federal structure, in which we know that the devolution of state share in tax revenue is increasing.
Right.
Yeah, so that money is there for them to service, and as a result of that, the market participants have not differentiated from one state against the other in terms of yield, maybe 2-3 basis point here and there, but there has been not been a significant deviation in market's perception. So I think RBI being there to service this SDL in terms of interest payment and other and issuance, that has been the central pillar. Right. For the market's comfort, and markets are not going to differentiate between states.
Right. So Sriram, you were making this good point about actually credit risk is all about ability to refinance, right? So what is your view on this?
Well, I can only say, just to add to what Dhawal said, this was in a FIMDA conference in Jaipur about a decade back. The then Deputy Governor HR Khan, in reaction to spreads at some point of time went up to about 100 basis points. So in a closed room, he kind of made the statement that I don't understand why market players assume it as a differential credit risk. I do realize that there is an illiquidity premium which you might attach, but so far as credit risk is concerned, it's as sovereign backed as you can imagine. There are ways by which RBI can trigger an automatic reset of WMA by the state and repay a particular obligation,
Right.
and can, as Dhawal mentioned, can exercise some mechanism to claw down on the center share of revenue that goes in. So there are mechanisms in place, though as I'm not completely clear. Of course, there's going to be an expert speaker in the second half who would be much more on top of how these things work. But we were told in as many words that they are. I think if I remember right, even Das had made this statement about 3-4 policies back regarding state finances, and
Right.
in reaction in a policy press conference, he did make the statement that they are sovereign risk. And
Right.
if you look at risk weightage for capital adequacy of banks,
Yeah, that's
they are placed at the same risk weightage as government securities.
right.
So they are as risk free, right, as government securities.
Right.
And yes, as Dhawal's point is that I do echo that.
What happened?
Thus far has been happening because of mandatory reasons. Your provident funds have to invest, insurance companies have to invest. So the moment you put this have to invest, the incentive to trade becomes less and less. I think if you now look at the stakeholders who trade or are willing to engage in SDLs are now people who are not compelled to invest, but who invest on their own. So I guess I don't think it's right to kind of assume that as risky. At the same time, we don't need to be completely oblivious to differential in state finances between one versus other, which is why RBI is also putting out a report on
Right.
how divergent they are. And some of these divergence, if it seeps into the pricing, also ends up disciplining some states
Right.
and makes them more sensitive to market pricing.
Yeah, so that was a question. I mean, how do, if individual investors like me want to choose between SDLs, sometimes we find the smaller states like the northeastern states actually issuing at slightly higher spreads, not much, but maybe 20 basis points above, say, in the big states. So, should you go for those, or how do you actually make that call?
Let me take that.
Yeah.
See, given the fact that there is a weekly supply, and on every week there are at least 6 to 7, 8 states issue bonds. So there has been a hodgepodge of supply.
Yeah.
So by last count, there are some 3,000 outstanding SDLI signs in the system, whereas government bonds about 100 odd, right? So if an individual investor has to invest in the SDLs, I think the best way is through mutual funds, because of two reasons. One is that the investors don't have to go through finding the bond for a smaller amount that they wish to invest. Second thing is liquidity. As Sriram pointed out, that SDLs are not very liquid as compared to government bonds. So by investing in it through a mutual fund, you are going to be able to circumvent this liquidity risk for the investors, and whenever investors want money, it's T+1 money is
Right.
in a bank account. The third is most important is the tax adjusted returns, because in India mutual funds are the most tax efficient vehicle. When you buy a bond directly, you are going to get coupon twice a year,
True.
and that coupons are going to be taxable at your
Slab.
marginal tax rate,
Yeah.
right? Whereas in mutual fund, if you hold it for longer than 3 years, you are eligible for long-term capital gains tax benefit. In a rising inflation scenario, that is a significant beneficial for you. So I would reckon that investors, if they wish to benefit by investing in SDLs or GSEC or any other fixed income instrument, mutual funds are the best vehicle. And within mutual funds, now that we have target maturity bond ETFs and index funds, which come with a particular maturity date and behave exactly like fixed deposits or a corporate bond, and then it provides a significant level of comfort in terms of predictability of returns. All these benefits work tremendously for the investors, and rather than finding your own set of SDL, they should only invest through mutual fund. That is what we would recommend.
Right. Do you have something to add?
Yeah, I mean, as Dhawal said, it's much easier and compelling from a taxation point of view to definitely go through a mutual fund than to kind of pick and choose a bond A versus bond B. But if you were to look at how an asset manager were to look at bond A versus bond B, there's not a single answer to it, like as Prasanna was mentioning, right? Higher deficit kind of gives you an incentive also, because if you believe that this particular state or this particular borrower is going to consolidate going forward, right, you would see that that could kind of have a salutary effect. And sometimes we all look at this debt to GDP, or we look at fiscal deficit to GDP, right? These are ratios. At the end of the day, India's GDP has not come back to the cyclical trend that we were at that point of time.
Right.
Unlike the case of developed markets like, let's say, US or a UK or any of these markets, GDP is kind of caught up completely with the pre-COVID trend rate of growth. So we are way below the trend rate of growth. Right? So if we get back to the trend rate of growth, we never did the kind of expansionary policies that some of those markets followed. So you would see that by and large the deficit number will look a lot more reasonable than what it looks today, primarily because your GDP numbers are much more below trend. So some of these higher debt to GDP or GSDP for some of these states can actually be an opportunity as well, seen in the light of that. So it's very difficult to kind of say, look, this is high, it's a vector and not a scalar.
Right.
If I could just add over there, I think in terms of total outstanding debt or indebtedness versus your fiscal deficit matrix, I think most states, I would not say all, most states are very responsible, and their numbers don't look very bad. So from that perspective, I would probably not be worried too much about the states. A case in point is Telangana. For example, Telangana, who has recently become a relatively new state, right? In the last couple of years, they have borrowed a lot of money for capital building. Right. So at some point of time, this capital that is being built, capital expenditure, is going to start earning. And as a result of that, after spreading, giving higher spread, now the Telangana spreads are now pretty much. So investors do look at why states are borrowing more and where is that money going. The point about the northeast states that you have raised, Nagaland, Mizoram, Arunachal Pradesh, they are very small borrowers because they are disproportionately higher recipient of the tax, government's devolution of tax. Because their population is low, but as a percentage of the formula that the government of India has worked out, these guys get a lot more money. So their demand for funds through SDL is very low.
So I have follow-ups on this target maturity, but taking a short break and coming to Lakshmi, I mean, so this municipal bond market is sort of an enigma to most people. So when you hear of municipality or corporation, I mean, you wonder whether the finances are in order and what are the sources where investors can go to actually check out their finances. And a more basic question about whether they do follow gap accounting and or Ind AS, because we know government accounting is generally not on even on an accrual basis. So what do you have to say?
So there are about 4,700 urban local bodies in India. About 248 would be municipal corporations, and then you have an almost equal number of municipal councils and nagar panchayats. About say 2/3 of the income of the entire urban local bodies comes from municipal corporations. You can see that it is the tier 1, tier 2 cities governments that are relatively affluent as compared to the councils and the nagar panchayats. And they do follow the National Municipal Accounting Manual, which has incorporated the gap principles. But whether they are all in the same stage of transparency, no. For most municipal corporations, you would be able to get the budget and the audited accounts on the website itself, and not so much for the municipal councils or the nagar panchayats. And transparency is an issue, but with all these incentives given by the government of India, the Finance Commission gives you a performance grant if you were to complete your audited accounts on time, and if you were to declare your service level benchmarks, if you make improvements in your database, you do get grants from the government. So it's this, with all these incentives, there has been a greater amount of information available. But still we have a long way to go, is what you can say about cities.
So today for state finances, we can readily go to the RBI and get fairly current information. But for the municipal bodies, is there any source in the public domain? Do they maintain websites of their own where they?
Yeah, almost all municipal corporations now have their websites, and you can go and get the budget and the audited accounts from there. The budget is more available because unless it is approved, you cannot spend. But the audited accounts are not that recent. Even for the some of the cities, you may get as of 2020-21. For many 2019-20 accounts would be available, which is a great improvement from how it used to be. Because there is a lacuna in this area only, I set up this company Munify, and we have a database which we have built over the years. First we built a library, and then we collected all this information, put it into spreadsheets, and then now into a tech platform where you can access all these finances with the contextual information. So if money is being spent, what is it being spent on, and how does it look vis-a-vis the other cities. I am sure that as more and more information is available and as transparency increases, there will be a far greater understanding of city finances.
Right. So have there been recent issuances, and what are the typical spreads over the yields at which?
The latest issue, Vadodara, was a huge success which happened in March. It was raised at the lowest possible interest rate at 7.15%, which is just fabulous.
Yeah.
And it led to such interest, and all these municipal bonds have been oversubscribed. That is because there is a ring fencing around them. Many of them achieve high safety ratings in order to appeal to insurance companies and provident funds, and you have to bring in as many as 2 interest installments in your escrow account. All of them have got a very high level of collateral. It's very, very safe. I have not seen a municipal bond default over so many years, much more safe than a state PSU bond. The typical spreads would be about 8 to 9% is what most cities have achieved.
Right. Is there a credit enhancement mechanism where the state government actually sort of guarantees it explicitly? I mean,
yeah, earlier it used to be raised with state government guarantees, and then you had this Ahmedabad Municipal Corporation issue in 1998, which changed almost everything. And here was a bond issue that was just built with the collateral of escrowing certain revenues, the octroi revenues, and doing away with the government guarantee itself, and that was a huge success and had retail participation. The issues that have come after that have not had an explicit government guarantee except for the Andhra Pradesh capital that is Amravati bonds that was guaranteed by the state government with the provisions being made in the budget but all of them are, like I said, very high levels of collateral. The interest and principal is in the account months before the repayment is due. There is a trustee monitoring it. These city bonds are high profile bonds, and I am sure if there is a mechanism and to improve the retail interest in these bonds would fly. There are only about said 1/3 of the municipal corporations may be ready to go for bonds, but the ones that you have there, the cities of Gujarat have gone there, Surat, Vadodara, and surprisingly Mumbai has not yet gone to the bond market. So from Tamil Nadu, a lot of bonds cities have gone. They have gone in as pooled funds as well, where small towns come together and they form a special purpose vehicle which raises these funds, and then the money is distributed for its water supply and sewerage projects. And in this case, the collateral was trapping the the grants that were coming from the state finance commission. So it was secured in that way. So they are no longer dependent on state government guarantee. Yes, there is an implicit understanding that if anything were to happen, the state government will support the city bonds, but all of them have enough collateral cushions that you don't have to look at a state government guarantee or its invocation.
Right. Have you had occasion to look at these bonds?
Yeah, I mean, I'm just trying to echo what Subalakshmi just said. In fact, Tidal Park, right, in Tamil Nadu did issue a bond almost about 18 years back or so, and this bond was initially ab initio guaranteed by Tamil Nadu government, and hence you always see that it picks the rating of Tamil Nadu government. Then progressively they found that Tidal Park generated enough cash flows and hence could on a standalone basis be much stronger financially than Tamil Nadu state.
Interesting.
So I remember, the then commissioner had gone back to the government requesting them to take back their guarantee, and if I remember right, the bond got upgraded also post that. Yeah.
Okay.
So there are instances. Have we looked at a municipal bond, as I said, there aren't too many instances. See, in any bond, you need to, faith is very important. Second is enforceability is also extremely important, right? When I'm lending money to someone, I need to be able to kind of enforce certain mechanisms to recover money. I still don't understand, how enforceability in some of these instruments work. Does it cede their power to enforce taxation? To what extent investors can influence? Some of those things I would like to see them get tested before we kind of go in. Right. If you had, as you mentioned, you had instances of state government institutions, state-owned institutions delay payments. Even central government guaranteed institutions have kind of delayed payments. So some of these guarantees, the way they really work through, when we have the jury is still out.
Right.
Even if I may just add over here, there was some year ago, there was a road show by Pune Municipal Corporation in Mumbai, wherein I think they had a very dynamic municipal commissioner who was looking to tap the bond market. And I think one of the insurance companies, I think Prudential ICICI Life Insurance, had invested money in that based on the commissioner's expectation. Then this commissioner got shifted. And the new person came, and then the priorities changed. So that also is sometimes a risk.
Right. So so that was one of the questions, like how do investors distance themselves from the politics of it and the governance issues? And
Banda is so important than Danda. Right? even if you look at private businesses, right? I mean, one of the larger NBFCs, let's say Bajaj Finance ex Rajiv Jain.
Right.
Would it be the same? I mean, while you want to believe that way, but in reality, it's very different to kind of sever the individual who kind of build the organization or what you epitomize. So it is very people centric.
Right.
Yeah,
actually, even the decision to invest in an old private sector bank is basically based on promoter group.
Absolutely.
So,
yeah, it is an issue. I mean, commissioners are changed every couple of months. It's
every
been
couple of
across
months?
the board. The longest tenure we saw was 1.5 to 2 years, and you have a good commissioner there for a couple of years. It can do wonders to the corporation. But I think with all this collateral, these escrow mechanisms, to some extent you can sort of de-link it from the commissioner. And one thing you must see that even the successive commissioners in many corporations have been as good. Now state governments are very, very aware that how the city is perceived can help them win elections. You should have seen the way the JHMC elections were fought in Hyderabad. I am based in Hyderabad. And it was almost fought like a national election. And state governments are now very clear that the city has to be well run, and that is very often the showcase of the entire government. Look at the flyover I have built. So they are very careful these days in picking very capable commissioners.
right. So that brings me to a related question. I mean, we have state governments also raising funds through other means. You have UP Power Finance Corporation or Tamil Nadu Power Finance Corporation, which used to come to the bond market. You also have this very popular, I know Tamil Nadu investors are totally enamored of these FDs of TN Power Finance Corporation and Transport Development Corporation, which offer yields of 8% or so. So, how do SDLs compare in riskiness to these kind of options?
See, SDLs are necessarily the first order liability. So they are carved out of taxation. So they are carved out of the budgetary allocations.
Right.
So none of these guaranteed corporations come as part of that. In fact, there's an old RBI regulation, almost dating back to around 30 odd years, where you cannot lend money. A bank cannot lend money against budgetary receivables in future. So this, if you look at the first principle as to why this regulation came in, you cannot compel a government to make sure that this allocation is made. You cannot, just because you have leverage. So otherwise this creates a disincentive for the present government of the day to kind of create a huge liability for next about 20 years to borrow future money and probably spend. That doesn't happen.
Right.
So, so state development loans are the first order liability. They are carved out of state finances annual basis. I don't think the corporations work that way. And as I said, you had instances in guaranteed businesses have instances of delay. Right? I don't think there was a default, but yes, delay. There have been delays even for 6 months and 8 months. Even central government guaranteed businesses have seen delays like that. I mean, the challenge that you always have when such delays happen is, let's assume if there's a central government guaranteed organization where there's a delay, right? Who do you go and approach? When the normal pecking order is the trustee of the particular NCD has to write a letter to the guarantee extender to kind of yank the payment. I'm not too sure if it will be very easy for a bank CEO in a public sector to write a letter to the Chief Secretary or the President of India invoking guarantee. So, in reality, you can always say this is the mechanism, but in reality, does it work?
Right. So, they don't have a private debenture trustee.
No, they do have.
They do have?
They do, but
See, if I could just add to what Sriram has said, that in a case where, I mean, SDLs are agnostic, it's automatically being serviced, right? Whereas when you are investing in the other institutions, like you have said, including government-owned entities, right?
Right.
There are people. Okay, so when you invest in a bond which is owned by Government of India entity, and it's also guaranteed one way or the other by Government of India. So, see, earlier the Government of India used to give carte blanche guarantee, all principal payments, all interest payments. Nowadays, Government of India has become very smart. They give rolling guarantee. That means this guarantee is for next 1 year.
Achha.
Then next budget, another 1 year. Then next budget, another 1 year. So, investors will have to take a call.
Right.
Whether the guarantee is going to be rolled over or not. And then one of the reasons when you see why Government of India is doing it, because Government of India, once they have learned from Air India's or other cases that when you give full guarantee through the tenure of 10-year bond or MTN or BSN, there is no incentive for these companies to improve. So what Government of India is trying to do is to provide incentive to these companies to improve their financials and balance sheet so that they can stand on their own feet.
Right.
And they are saying, look, I am not guaranteeing more than 1 year. It's like a responsible father telling a child, right? This my pocket money is only for this week, not next week you have to go and work. So similarly, so this nature is changing, and when what happens is that if the companies are not able to improve for one reason or the other, then things get messy.
Right.
And then files have to move from that company to that ministry, from that ministry to Ministry of Finance, and Ministry of Finance has to work in time. So then the debenture trustee is just looking at things, the files move, and then investors are praying to God that money will be released on time based on the T structure. So it raises some amount of anxiety. I'm not saying that they default, they don't default because the T structures do kick in, but you are at the mercy of people.
Right. Even a delay can reduce the yield, so it's...
See, largely, der hai magar andher nahi, you will get your money back. Even if you look at those private businesses, which I mean today we talk about NCLT as a panacea for solution to most of these things. The way some of these things work once there is a problem is very different, right? In theory and textbook, how it works in textbook versus how it works in practice. The moment till the time there is a default, you see every creditor is united versus the promoter. The moment there is a default and you take it to NCLT, the promoter is off. Then it's just one creditor versus another creditor. Right? I mean, it's the way a building association works with each other, right? You see that you're fighting among colleagues and not with. So that's how it is.
Right. So in this context, I mean, we've also said, coming back to the topic of SDLs, we've seen SDLs at times trading at higher spreads than the AAA PSUs. Now, recently the AAA PSU spreads have become very thin and at 30-40 bips and all, even less than that at times. So, is it fair for the SDLs to trade at higher spreads than the AAA PSUs? How do you choose between the two really? I mean,
see, the reason why SDL spread were higher than the AAA PSU spreads in the last 1 to 2 years were because of idiosyncratic reasons. Okay. So what had happened is post pandemic, because of the collapse in the economic activity, and the states funding needs increased dramatically because the government devolution declined.
right.
So the states had to issue a lot of bonds in order to raise their money, and you know that out of the total source of fund requirement increased dramatically, and that resulted in widening of credit spreads. Whereas on the other side, because of lack of activity, the supply of AAA PSU declined because there was nothing going on. Usually habitual borrower like PFC, REC, IRFC, NHAI, Power Grid, that suddenly for each one of them different factors started playing in. For example, Power Grid did an INVIT, so their funding needs were satisfied, so Power Grid was out of the market. For NHAI, government has taken over the liabilities of funding them, so NHAI is out of the market for this year. Power Finance Corporation, REC, they started getting prepayment because of the several measures that the government of India has taken to revive the power discom and came out with the mechanism. So, for various idiosyncratic reasons, there has been a very sharp decline in supply of AAA CPSEs on the long end. Whereas for insurance and pension funds, their demand became very, very strong. As a result of that, the spread of AAA CPSEs on the long end just tightened in the last 2 to 3 years, whereas the supply of SDL resulted in widening of the credit spread. So that's why suddenly people started imagining that SDLs have become riskier than AAA CPSEs, whereas it's not. I think it's going to normalize at some point.
See, you go back to first principle on pricing any security. Sometimes the spread between a government security versus SDL or a GSEC versus AAA is not necessarily a function of only credit spread. It's also a function of relative illiquidity spread.
Right.
In fact, today an IRFC or probably some of these bonds or an NTPC bond would today be much more liquid than sometimes a SDL bond. So during times of high liquidity versus times of relatively or as we progress towards less liquid times, illiquidity spread also kind of plays a role in this. So hence, not all the differential spread is only because of credit risk.
Right.
And there is also bucketing, whereas like in insurance and pension funds and NPS, there is a special category for corporate bonds. Okay, that cannot be replaced with SDLs or GSEC, even if you got at higher spread. So people will have to buy corporate bonds and they have to buy longer dated corporate bonds for that bucket.
So there's a 10% housing. So the moment you talk about 10% housing, I mean, you had one large housing company go into stress. A few other housing companies started contracting balance sheets. So hence the issuances came down from that, as Dhawal was mentioning. And some of these are obligatory sectors on the part of insurance companies. And insurance companies did see sizable inflow of money. Once again, post-COVID, once again you saw inflow of money. So all these things kind of contributed to a skewness in demand supply, which tilted this.
Right. So coming back to the subject of muni bonds, what do you think can be done to improve liquidity? Is there liquidity given the small issuances, and how do buyers typically exit prematurely if they want to?
Currently the investors tend to be life insurance companies or provident funds, charitable trusts, these funds who need to hold investments for a long time. So there's very little liquidity, very little trading, only a small quantity of these bonds available, and they're all highly rated also. So investors tend to hold them also for asset liability matching. These bonds are typically about 7 years to 10 years tenure, few of them for 5 years. But the way to improve the liquidity is to bring the retail investors into the market. Internationally, you get tax exemptions for these bonds, but in India we have removed these tax exemptions because the investors are typically those who don't need it. They don't pay tax. These are like pension funds and provident funds and those sort of investors. But as the retail base grows, there will be a need to make it more liquid, and trading will be there. So the answer to this is to build a very good retail base, and for that there has to be different kinds of bonds. For instance, very city centric bonds, community bonds, bonds which for instance if you were to in the high-tech city region of Hyderabad, if you were to put up a particular project, or you just say you managing solid waste for residential welfare societies, you put up those plans. These are mini bonds. Those sort of innovations have to happen, that the citizens are so involved with the bond that there is an incentive to subscribe to it, and then the after effects, the impact of the bond is felt in their daily lives. That is when the retail interest is really going to grow. But that some large scale interventions are required, and these are still at the level of discussions and ideas and policy suggestions. But in the coming years, you would find a sort of an explosion in this space. That's bound
So
to
is there is retail participation allowed? And
yes, it is allowed, but the investor interest from the institutions is so much that
Right.
there's hardly anything for individuals to pick up.
It's a very nice, interesting point. We've been talking about deepening bond markets in India for last about 30 odd years, or I mean, as long as bond markets have been there. The challenge largely is to get non-correlated investor
Yeah.
segments to come and participate, right? If you look at even government security market, and me and Dhawal were discussing this yesterday as well, 40% of government securities is owned by banks, out of which almost about 80-90% is mandatorily held as HTM and SLR. Right? So hence that part doesn't come out and trade. Insurance companies own about roughly around 17-18% of outstanding government securities, and they trade for 1% of market's total trades. Primary dealers hold about 1% of government securities and trade for 17% of market trades. Right?
right.
And 20% of government securities are held by RBI, which doesn't trade as much. Right? So if this is the kind of market structure, your government security market is, while you might always say on nominal terms it's very liquid, it trades for 30,000 crores. 3 securities trade for almost about 90%, Dhawan.
My God.
90% of your trades are out of 3 securities out of 120 securities. So government securities markets are less liquid. So the only way to kind of get the markets to be more liquid is to make sure that mutual funds start seeing a lot more of retail flows. When we have seen retail flows come into equity markets, and that gives a lot of stability to financial markets in India. Similarly, we need to see retail flows come into, in a big way, come into fixed income markets, and that gives stability. Because retail is the only segment where you see a bit non-correlated investor behavior.
Right.
Institutions, banks, you might say there are 28 banks or 30 banks, but all of them kind of behave. It's a very sector-specific view, kind of decimates very
Yeah, they may
fast.
not have a divergent view of. Yeah,
Precisely.
true.
So if you have 4 segment of investors or 3 segment of investors, the market is resembles like Bombay suburban train every time, peak hour traffic. In a bull market, you see everybody is on one side, bear market, everybody is on the other side. Bus.
It's strange we are discussing this because if you look at it from the retail investor's point of view, the number of high yield fixed income options is really limited, and that's why people take very, very risky bets. There's either very safe AAA and government securities, or there's the other extreme of fractional ownership in warehouses or leases or something like that. So we need some in between market to actually come up, because, and I also think today risk taking among retail is really going up. I don't know whether it's a function of the markets or it's a function of change in behavior and the mindset, but both in equity and debt, people do have a risk taking mentality perhaps. We need.
Which is true, I'm sure even academic material keeps saying, people keep alternating between brains and bull market. It's a very normal thing. Right? In good times, you always feel it's my brain and I've kind of done it. So it's a very normal thing. But then you are right. As you start seeing the markets increase in depth, to a large extent, market's ability to do risk transfer also gets more and more efficient. Right? Investors also have to take informed decisions. If they believe that they don't have the time and wherewithal to take informed decisions, they need to seek professional help in whichever form. It could be a simpler solution like invest through a mutual fund, or have a financial advisor to kind of advise them. Whichever way, you need to kind of make sure that, we don't kind of self-medicate ourselves. So it's similar way. You need to make sure that you need to kind of seek the right kind of advice. Right. Every investment has its own risk versus return equation that keeps changing. It's not fixed. It's a very stochastic function that keeps changing with market cycles.
Right. But I think to be truth, and if you look at the data, I think clearly retail investment is coming in big time. In the last 2 months, September as well as August, we have seen a very sharp increase in the supply of AT1 bonds.
Okay.
Right? I would say between SBI and other banks, close to 50-60,000 crore worth of AT1 bond has been issued in last 2 to 3 months. Entire thing is absorbed by HNI and retail. So investors, we feel that they are not investing in a proper manner, but I think somewhere, if you look at this thing in a disproportionate and dispassionate manner, you can see clearly that hierarchy of preference. they view banks and bonds issued by banks at significantly superior as compared to anything else. And it's very clear. So every time there is an SBI or a Union Bank or PNB or XYZ coming out 81 cut.
And yields are also barely compensating for the.
Absolutely.
Yeah.
In fact, the funny thing is, I don't know how many investors are conscious about the fact that there is no maturity. This is just a call option. The call option is not the investor's option. It is at the option of the issuer and not the investors. So that's point number one. Second is these bonds have certain loss absorption features built in, right? A non-payment of interest is not deemed as a default also. So even from a rating point of view, if a particular perpetual bond skips an interest payment, it will not be deemed as an institutional downgrade at all. So I don't know how many investors are very conscious about some of these things. In fact, the other thing is we need to see how a regulator would view, because very often investors believe that call option is a deemed maturity.
Right. Yield to call is the basis on which they trade actually.
Yeah, exactly. So irrespective of whether the call is in the money or out of the money.
Yeah.
So it will be interesting whether if a bank which has issued a 7% perpetual today or 8% perpetual today, in future when that same bond were to be replaced with a 10-12% perpetual, would the regulator be okay about calling back a 7% bond and allowing it to be replaced with a 10%? Because calling back a perpetual bond would require a regulator's approval. They will look for the bond to be replaced with either an equal quality of equity or even better.
Right. So coming back to target maturity funds, they are among the higher yield options available today, especially when you have this mix of SDLs plus gilts or pure SDLs also there are some funds. So my question is, these target maturity funds typically are passive and they mirror a custom made index, right? So how are the securities selected for this custom made index which is given by say NSE or CRISIL? I mean, do you have a hand in it as an investor?
So if we are talking about SDL, target maturity funds only investing in SDLs, right? Generally speaking, the indices are made based on three things. First of all, because it's a target maturity, so there is always a certain window of maturity or look back period. So the index normally figures out how many states bonds are maturing or SDLs are maturing in that bucket.
Right.
And then within that you are applying more filters like number of times it has got traded, so liquidity, number of days it got traded, and the amount outstanding. So there are 3 to 4 filters that are applied to select and come out with an index which gets rebalanced on periodic basis, whether it's monthly or quarterly, to incorporate new supply of bonds, SDLs, which are qualifying under those criteria.
Right.
So that way index is always evolving and it provides for higher level of liquidity or higher level of volume or higher level of number of trades that takes into account for the previous quarter or so. So that way index is very dynamic.
Right. How closely are you able to replicate the index? Because in passive debt, I've seen that replicability is not as easy as equities.
Yeah, so the regulator is aware that in fixed income, replicating an index is not easy like an equity, where for every stock that in the index you can replicate that percentage. So for fixed income funds, the replication methodology has been slightly more dynamic. And whereas particularly you are talking about government securities and SDL, you don't have to buy the same bond in same proportion.
Right.
You can replicate the index based on modified duration. That means if the index is a modified duration of 3, then within the various different types of government securities and SDLs available in the market, you have to, your portfolio can have a modified duration of 3, so closer to the index modified duration, but you don't have to
exact
have the same
composition.
Yeah, so that way SDLs and GSECs are considered homogeneous.
Right.
So in an index, say A, B, C, D, E, F, is that they are the states, but in your portfolio you can have PQ or STU.
Okay.
But as long as the other characteristics of modified duration and other things are similar.
Right. Right.
So that much flexibility is there. So that compensates for the illiquidity of the SDLs in the secondary market.
Since you are not going to own a spectrum of maturities, right?
Right, only
it may not
one
be that difficult. You are going to focus only on 2-3 around that. So the
Right. And most of these funds are run on open-end structure. So, the problem is in India, retail especially tends to exit gilt funds when the past returns are negative, which is the exact opposite of what you should do. So, if that happens to target maturity funds, how will you handle it and how will you stick to the maturity?
So, Aarti, that's a very relevant question, and over the last 2 to 3 years since the evolution of target maturity fund, it is our experience and a very pleasant experience that investor interest is proportionately growing as yields are going up.
Right.
So, in fact, as the yields go higher, in conventional fixed income funds, we see redemptions because institutional investors exit when the yields go higher. Whereas the retail behavior investor does completely different, which is what they should do, as you rightly said, that they invest more. And as a result of that, month after month, yields have been going up since December of 2021, right? Month after month, we have seen net inflow in target maturity, bond, ETF, and index fund. And that provides us with slightly higher level of comfort that the investor behavior has matured. They have understood what target maturity funds do, what are their benefits for them, and most of them are not coming with a tactical allocation.
Okay.
They are coming clearly for a long-term fixed income allocation in their portfolio. So, whether now that at Edelweiss Asset Management we have the plethora of maturities from April 23 all the way to April 32, we always emphasize the investors that please pick the maturity based on your investment horizon and then invest only, so that you are not making a tactical allocation. And if anybody is coming for a 6-month period, do not invest in a 5-year target maturity fund or a 10-year target maturity fund. That is completely not advisable. So, that message has gone down very clearly, and I think investors have understood what they are getting into.
So, it is strictly matching to the goal and they don't take a view on yields, etc.
That's highly ideally it should be done.
Right.
See, there are two categories of investors, and HNIs and individuals do have that ability to give time to their investments, right? They can always take those calls at Dhawal. The problem also happens because there are a lot of vast majority of corporates and banks and insurance companies and other investment companies that probably come and invest in mutual funds, right?
Right.
They have a different operating cycle and funding cycle. So, imagine any business would have gone through last 18 months or 2 years back with a very different kind of a business cycle. You would have seen working capital contraction, a lot of cash flow being released, and those cash flows were parked into mutual funds. Right? Now, as working capital cycles are expanding, you see that businesses are expanding, credit markets are tight, you would see a lot of them go and redeem money. So, individuals and businesses operate very counter-cyclically in some ways.
Right.
So, that happens in more actively managed funds, but in target maturity funds, I think even wherever there are corporate investors, they do realize the importance of being aware. And I think one of the reasons which has contributed to this sticky behavior is this predictability of returns.
Right.
When investors invest in an open-ended fund, they don't know what they are going to get into.
True.
And depending, even if they stay for 1 year, 2 year, 3 year. Whereas in target maturity fund, there is a very clear understanding that if they remain invested till the maturity, what kind of return they should expect. So, investors, when they are looking for exit, they try to figure out that if they remain invested for whatever period, what is their secondary opportunity, what they are going to get if they redeem today, whereas if they remain invested, what are they going to get. So, this kind of transparency and clarity of returns have also improved their investment behavior.
Right. That basically, since funds disclose their YTMs, you are able to figure out using the expense ratio. But the YTM disclosures are monthly in the cases of most funds, right?
Well, now I think the transparency has improved. In as far as Edelweiss Asset Management's case, we do daily disclosure of our portfolio on our website. I think we at Edelweiss have one of the best level of disclosures, and we are setting up industry standards for that. So, and I think we believe that higher level of disclosure is always better for the investors, so that it increases investor comfort.
Right.
And not only about yields, but 100% of the portfolio disclosure.
If the state governments decide to roll over their debt at maturity, is there a problem with?
It happens all the time, right? Because the government of India and as Sriram mentioned, their businesses, their balance sheets are different.
Yeah.
They always look for their ability to refinance.
Correct.
The day that trust is broken, that the country will stop functioning.
Right. Okay. Okay.
If I were to say, cliche, but even ILFS could have gone on for another 100 years as long as money kept rolling. So
True.
Unit 64s or ILFS, True. The flow of money kills businesses when you strangle that. Liquidity kills faster.
Right.
It's like oxygen.
So how can an investor take this? Suppose today target maturity funds are available for 5 year and for 1 or 2 year, even 10 year. But I am seeing a lot of state governments issue bonds for say 30 year, etc. And suppose I find that today the yields are attractive and I want to lock in. I mean, should I be doing that? Is there a risk? What should people be looking at?
See, now I think mutual funds, we have launched recently 2037 index fund, which is going to focus on government securities and STL. I believe that other mutual funds are even offering 30-year product, target maturity product. So I think all these things are aimed at creating a very long-term fixed income allocation in the investor's portfolio. I think investors are also looking at clearly an alternative to PPF or any other product because insurance, as you know, offers only 4 to 5% kind of return on a long-term basis. Whereas now the yields are closer to the peak and now we are between 7.5 to 7.75. Some investors believe that's a great time for them to lock in long-term yield maturity at current level. There is also an increasing belief that as Indian economy is going to mature, and the tax revenues are going to improve, the yields over the long term in India are going to decline. Okay, because if you look at the yields in the region, even countries like Malaysia, Thailand, Singapore, Singapore is not a right comparison, but they all have 10-year yield in the handle of 3 to 4%. Whereas India and Indonesia are the only two countries where the yields are 6 to 7% handle. So, if you believe that Indian economy is going to mature and move in the right direction, gradually the long-term yields are going to fall. And in India, so investors do keep that thing in mind, and there are a number of investors are looking for very long-term investment solutions.
Right. As a private investor, do you see this as a good time to lock into say 30-year paper or 20-year paper, or do you think we should bide our time a bit given that there are so many?
As a private investor, we do see, as an endowment, we do see value. We are a full taxpayer entity. So we do see immense value in locking in money. I cannot be very precise about these. When will yields favor certain policy favor? Certain amount of policy favor is already seen due to the term code. So I can be approximately right about this or be precisely wrong about this. So I would rather take the first one and say at this point of time I would start building a portfolio in longer term fixed income, taking some of these 10-year constant maturity or whatever part of the term code and seeing value, and then wait. Difference between 10 and 15 sometimes in India is very, very thin. Right? Sometimes it widens to about 20-25 basis points. Otherwise, by and large, the median range is about 10, 11, and 12 would be value. So we are around the median range. So it does offer value. The difference between 5 and 10 is almost negligible. The two additional points that I would like to make over here is that assuming the 10-year or 15-year product is currently yielding close to 7.5%, and assuming your average inflation is going to be 5% over then you are paying 20% tax on remaining 2.5%. That itself will take about 50-60 basis points. So by and large, I think investors are looking at between 6.5 to 6.75% tax free over a 10 to 15-year period. And that is the sovereign underlying. Whereas the tax-free bonds are currently yielding close to 5.5. So there is an increasing awareness among ultra-HNI that by investing in vehicles like this, they are creating a quasi tax-free bond portfolio for a 10 to 15 or 30-year period. And this is something that is extremely lucrative for them. And second thing is that, to answer answering your question whether you're right time to invest, one of the ways to mitigate this is spread your bets. So rather than investing all your money in one point of time, you invest in 2 to 3 or 4 tranches. And that's how you average out your investment in this kind of way. And particularly those HNIs and family offices, they get yearly money in. So they are not deprived of investment opportunity. They get money net inflow. So they can always average it out. As long as the underlying vehicle and the investment hypothesis is according to their expectations. See, equity markets are very unpredictable in near term, but very predictable, reasonably more predictable in longer term. Fixed income markets are exactly the other way. Very predictable in near term and less predictable in longer term. Right? We can always say that we are trying to be very cute in saying that yields are at 7.5, it will go to 760, 770. All we need to assume is what will happen over a 3-year perspective, right? Though we know that we are, and inflation is cyclical. There's nothing called structural inflation. You'll see that as you have a lot of fear that seeps into the time curve, 3-year time around this cannot be the case. You could exactly see something the other way around. So over a 3-year period, which is what your taxation cycles are, it's reasonable to assume that bond yields will are reasonably valuable. 1 year.
So I think we got a very good perspective on SBLs, even on the level of yields, whether it makes for a good investment opportunity. Is there anything, Lakshmi, on mini bonds that you would like to add before I sum up the whole session?
Yeah, I'd like to talk about the future of these bonds. As I mentioned, cities are in the forefront of tackling many challenges, and not all of those will be tackled by municipal corporations. Now, as per SEBI guidelines, other municipal-like entities, which means SPV, special purpose vehicles of smart cities strengthens bonds. It could be any entity that is in the urban space. It could be the Urban Development Authority, state water supply and sewage group that already gone into the market. You could have city transport corporations borrowing bonds for financing electric vehicles and public transport. Solar energy is another area. So you will find that since many of these entities also now can go into the bond markets, you will find more municipal bond issuances, and since the base itself is so low, it can only improve from here. But some large-scale interventions are required. Abroad, we have something called financial guarantee insurance, where a standalone guarantor, an insurance company, lends its credit rating to the bond. So if you have a very well-capitalized insurer, which has AAA, they can lend their bond rating to the municipal bonds and enjoy collective treatment. These sort of interventions are simpler for retail investors, rather than complex collateral realization that you do, which you may not even understand what is a pooled fund. And the second is some large-scale recapitalization of the balance sheets of municipal corporations in order. So far, this research has not been put out. This is something that we are working on. That to be able to say that you can aim for the moon, but on the strength of the balance sheet, what is the maximum possible bonds that can be raised in 3 years' time? And if this is where you want to go, then how do you recapitalize this balance sheet so that these bond amounts are achieved? It has been done before for the banking sector. There's no reason why the municipal balance sheets can't be recapitalized. Overall, there could be a variety of bonds coming, especially for green financing, the new initiatives, and not just the municipal corporation. Smart city SPVs are very professionally run. If you just take a look at their balance sheets, it's as good as any corporate balance sheet. These are the guys who could be coming to the market from now.
So to sum up the session, some of the big takeaways were that firstly, there's no need to be overly concerned about the precarious state of state finances, especially because FPOs have this up-gradation mechanism to actually make sure the payments are on time. Secondly, that in municipal bonds also, as Lakshmi enlightened us, there are good opportunities coming up, and there are mechanisms in place to ensure that the repayments are not a problem. So it is a category that is worth looking at. A third takeaway was that if you have a longer term horizon, then the mutual fund route, particularly target maturity funds, do score over holding individual bonds perhaps, not because of diversification particularly, but because of taxation advantage, which is very distinct, where you can convert your coupon payments into capital gains and basically have indexation benefits on it. And of course, the final takeaway that this is a very decent level of yield at which to actually lock
into long-term instruments, whether they are floating or SDL. And we learned a lot about the municipal bond market also, so thank you so much. So can I now open the floor to audience questions? I see that I have received a few questions, so I'll start picking them one by one and I'll keep sending them. So why is market making not being explored to improve liquidity in say FPOs or green bonds? That's one of the questions.
Global security market does have market rating. Primary dealers are doing well there. But there are limitations up to which they can also kind of do it. They get financing from RBI. They don't get backstop on market liabilities and market losses. So there is certain mechanism in working government security. But the other challenge about market making is if the market structure in India is so one-sided with just about 3-4 segments, it becomes very difficult if one dominant segment wedge cannot hit the market. The strength of the market maker has to be reasonably large. The only big old market makers can actually be retail. Actually be when retail flows come in. Even look at your equity markets, right? Forget whether their valuations are never digits and never day, but the markets have been reasonably more stable than global markets, primarily owing to non-correlated retail flows that came into India post demonetization over the last 2 years at least. That is what you need in. If I may just add to what Sriram has said, one of the primary importance for any kind of market making is the access to retail market. So wherever there is the securities are redeemable, you will be able to see the ability to warehouse, to be able to hold. We have seen that government securities are very easily deployable, whereas the SDLs are not very easily deployable. And this is because there are idiosyncratic factors, because there are too many securities out there, they are less liquid. So as a result of that, the market makers are not able to deploy their inventory. So it's a chicken and egg story. So I think things are moving in the right direction, but it will happen.
So question which is a slight repeat of the so it's for you, Dalal. You were mentioning that SDLs are not being deployed, then how can you housing them in open mutual funds?
See, out of the 28 states, right, there are 20 states who are issuing frequently. And within the 20 states, there are, if you look at the secondary market liquidity, I think the top 5 states are also very, very liquid. Maharashtra, Uttar Pradesh, Tamil Nadu, even Andhra Pradesh. These SDLs are very, very liquid in terms of relatively speaking. So normally the way indices are being constructed, they take into account not only outstanding but also about liquidity, number of trades and then amount of trades and things like that. So in general, it is our observation that most of the time the underlying index will also end up mirroring what is the reality of the market. And from whatever vantage point that we are, I think mutual funds are holding almost 80,000 crores worth of SDL. And within that, I would reckon that only half of them are invested in these target maturity funds, which are only getting net inflow. So it is our belief that whenever cycle turns, I think selling 20,000 crore, 30,000 crore worth of SDL shouldn't be a problem over a period of time. Not in one day, not in 2 days, but over a period of time, particularly given the nature that it's some sovereign risk. It is not something that buyers will sit and they'll ask, इसका लिमिट नहीं है, उसका लिमिट नहीं है, there's sovereign risk. So at a price, it will sell.
So Lakshmi, there's a question on muni bond. So interest income for muni bonds is tax-free at the federal and state level in the US. So should the Indian government also look at tax breaks to deepen the bond market?
We had tax exemptions earlier and that was removed.
and there used to be a ceiling of 8% even if it is tax-free. And like I said, it is something to do with the nature of the investors also. A provident fund is more interested in getting a good interest rate and therefore income other than a tax break, whereas an individual would be interested in for tax purposes. As you have more retail investors, this is something that will have to be relooked. You don't have to put a ceiling on interest rate, that may not be there, but tax breaks for individuals is likely to come as there is more retail interest in greater demand.
If you say that, then everybody will wait for the tax bill to come before investing.
These are very good. Like I said, that it's more a question of availability of bonds. Mutual fund at one time Franklin Templeton was an active investor in municipal bonds. There is great quality is excellent, but I think the issue is not enough paper out there in the market, and that will happen only when the credit quality of the munis improve. So if the LBOs are at a certain pace, new bonds are at least 10 steps behind us.
So, this is for you. There are some ambiguity regarding the guarantees for state bonds like liquidity law. Can guarantees by RBI help foster the market for state corporation bonds, particularly where it goes to finance infrastructure?
I don't think RBI would guarantee any state government bond. In fact, RBI is not explicit about even guaranteeing state government debt as such. So, in fact, even NPPCL, if I remember right, there are two series, Series 1 and Series 2. In fact, after the Series 1 was marketed saying it's as good as an implicit guarantee, there is no guarantee, there's a mechanism by which RBI would restore the cash flow and pay. And this was kind of overemphasized by the issuer as they marketed. Even before the second series was out, RBI kind of asked the issuers and market makers not to emphasize or not to use that at all. Which is why to some extent market believed that the first one was guaranteed, the second one was not guaranteed. Actually there's no guarantee. Even those mechanisms RBI wanted to distance themselves from even these mechanisms we were signed up for. So I don't think the idea is for RBI to get into state finances, let alone state finances guaranteeing state businesses. That's not going to happen. I think we are not going to live long enough to see that happen.
I would just add to this relevant point. I think people like UB Power and other things, I think investors are not aware that there are two series, and one of them has a mechanism, other does not have a mechanism. So a number of times there is a misinformation that investors should be aware of, beware of. So there is always a concept of buyers beware. And this is why I think something you will have to be very careful of. Get the proper information before investing. Don't take every information that is provided to you at face value. We need to trust but verify.
So there's a question, how volatile are state government SDOs in the secondary market?
If you look at CCI data, and CCI does a great job in publishing this data, their data suggests that the spread of the issuance is higher than the spread in the secondary market. So maybe because a higher amount of money auction is created attractive opportunity, but their data suggests that the secondary market spreads are always tighter for the same ISI after the primary issue. So that clearly means that somebody is buying these bonds at a higher price after they are issued. So from that perspective, and then this is not a trivial spread. In the tightening, the spread is between 7 to 8 basis points. So assuming the average duration or average maturity of these bonds are about 9 to 10 years, right? The 7 to 8 basis point tightening is actually 50 paisa price appreciation in the same quarter. So that's a great way of trading.
So Subalakshmi, final question. Some skeptic is asking, you can't create retail interest in central government securities, how can you create retail interest in muni bonds?
I totally differ. That's why I said the future of bonds are going to be these community bonds. For instance, the stray dogs munis, which is something that we were talking to the state government about. Every time there is an intervention, we have all these animal lovers jump in saying, how can we do this to the stray dogs? Now, if there can be some humane ways, which is very obviously having these animal shelters where you sterilize these dogs, hold them in these shelters for some time and then release it, having animal canteens where these stray dogs are fed so that they don't go around attacking children and elderly on the roads. And this is now a nationwide menace. Now, if in the more affluent areas, for instance, if this money can be raised through crowdfunding, just giving you an example, and you have people who are interested in seeing their locality safe, crowdfunding for building these animal shelters. Now the entire community is involved in it. If on a portal I put up, at every stage, what is the stage at which this construction is the shelters like this, it is maintained, and all the people who have donated for this cause, their names on these animal shelters, and announce it like a civic award, there would be terrific participation. And I talked about these residential welfare societies where, recycling of waste is a huge issue, and if biogas can be generated or the common maintenance areas can be electrified with the help of this regeneration of the solid waste, and so putting up this 1 crore, 2 crore plants around welfare societies in a city, and if you're raising bonds for that, there could be interest participation in the community. Or if you say you are rejuvenating a stadium there, not the cricket stadiums of course, but so for instance a badminton stadium. I'm giving you an example of Hyderabad, which is the badminton center of India, and if you're raising bonds over there, to be able to hold international events and to spruce up that area with the assurance that all those who are funded, their children get access to the stadiums. It's only a matter of imagination of involving the community, and you will find that city bonds are actually the best place to improve retail interest, where the person who is investing the money is also going to benefit from the project. Retail interest would be terrific. And this is something that is going to happen. In other countries, such community bonds have financed parks, bridges, wherever the community has benefited from it. So you could find that tomorrow the retail interest coming primarily from city bonds, and not necessarily for the yields, but because they want to participate in that cause.
Yeah, I can very right that because a lot of young people today want to are believers in ESG investing, but while older people are a bit simple about it. So, and they also want to make a social impact, and so as these bonds go come, you see so many MILAP and TETE campaigns raising money without much due diligence. So I think this is a far more safer way to contribute to your local community to have some social causes. So on that note, we are running out of time. I thank the audience for their patience. It was a somewhat technical session, and I hope we were able to give you some useful takeaways, actionable takeaways from this. Thank you.
Thank you so much, Dhawal, Subalakshmi, Sriram and Azim. So I do not know if we'll get transferred the day I lunch break. So we'll start the next session at 1:30. This time Ravi will definitely be on time.